So what exactly is an audit? We're going to go through what the audit report means and what some of the terminology is. But to start, it's an objective examination and methodical review of an enterprise's financial statements. And the purpose of the examination is to express an opinion on the financial statements. That opinion is, are they in compliance with GAAP? The opinion is delivered in the form of an audit report, but it's not the auditor's job to make the corrections or do any journal entries. They just analyze selected transactions and look at the financial statements to make that determination, express that opinion. So who can perform an audit? You have to be an actively licensed certified public accountant to perform a financial statement audit. This is different than a tax audit. So there are certain responsibilities that come with auditing. The management is responsible for the creation of the financial statements. The auditor simply expresses an opinion and delivers that opinion to management. If they find a problem, they communicate with management, but it's management's responsibility to make any correcting journal entries. So what's the difference between accounting and auditing? Well, accounting, that is recording, classifying, and summarizing economic events in a logical manner for the purpose of providing financial information to decision makers. And then, of course, creation of the financial statements. Auditing, it's determination if those financial statements do represent the economic events that occurred. And it's stating an opinion as to the fairness of the presentation of the financial statement. It's an attestation service. Now, question, a good audit report guarantees there are no material misstatements. This is false. If the auditors do find mistakes, they will make the correcting journal entries to assure the financial statements are in accordance with GAAP. This also is false. It's management's responsibility. The audit provides reasonable assurance, but not absolute assurance, the financials are presented in accordance with GAAP. This is true. Management's responsibility for the fairness of the assertions in the financial statements carries with it the privilege of determining which disclosures it considers necessary. This is true. The auditor can turn around and say, well, if you're not going to disclose this, you're not in compliance with GAAP. And that's where the auditor is more of a business consultant, advising the management on how to become fully compliant with GAAP. Where a tax audit is different. Financial statement, it's more you're been hired as the auditor just to give business advice and to deliver that audit report. The auditor will make suggestions for disclosure clarification. If management refuses, the auditor may issue either an adverse or a qualified opinion or withdraw from the engagement. This is true. Now we'll talk about error versus fraud. And error, that's just a mistake. We all make mistakes. Auditor will suggest a correction or issue a qualified or adverse opinion. Fraud, that is when we're talking about intentional, illegal acts. The auditor must withdraw. And that's the audit rule. There are generally accepted auditing standards, abbreviated as GAS, which state that if an auditor discovers illegal acts or what they suspect to be illegal acts, they're required to withdraw instead of continuing and then delivering a qualified or an adverse opinion on it. So a little terminology here. You will hear unqualified, qualified, adverse, and disclaimer. This is the terminology you will hear, and it may feel a little backwards at first, but there are some tricks to try to remember this. And the other thing an auditor can do, they can withdraw. They don't have to deliver an opinion at all. So first, what is unqualified? Sounds bad, but it's not. That's a good report. Think it does not qualify for further review. The auditor agrees with management. So unqualified, that means a good financial statements. They are incompliant with GAAP according to the auditor's opinion. A qualified opinion, this is where the auditor wants to emphasize just a specific item. It contains an exception to the standard unqualified opinion, but not of sufficient seriousness to invalidate the financial statements in their entirety. It's a material amount, but not severely material. So you can think it's bad, but it's not too bad. Overall, the financials are in good shape, except for maybe one or two areas. The third opinion is an adverse opinion. This is necessary when the exceptions are so serious that a qualified opinion is not justified. Adverse opinions are actually rarely issued because you're working with management. You've been hired by this company to audit their financials. They want your opinion. They want to be in compliance with GAAP. Auditors can usually persuade management to correct the problems. That's their job. They audit the financials, deliver their opinion to management, not in a written audit report. Then management decides, are they going to make the corrections? Then everything is finished with the audit report. For an adverse opinion, the materiality level will be significant. So you want to think bad, very bad. Now there are exceptions. Nonconformity with GAAP, inadequate disclosures, limitation or restriction of the scope of the examination of the financial statements. So maybe you come in and you have all of this information to analyze as the auditor, but then as you're going through it, there's some things missing. Maybe the ending inventory count isn't there. You weren't able to get your staff there to visit it and to observe when they did their physical inventory count. So you can't really make a statement as to your opinion of the accuracy of cost of goods sold and ending inventory if you don't have that inventory and information. Now there are some tests that auditors can perform, but this is just an example, a broad example of what a limitation or a restriction of the scope of the examination might be. And that's where a qualified opinion might be advised. So auditor's opinion, qualified, if an auditor gives a qualified report, opinion, that means it has to do with a GAAP problem. It can also be due to just an audit problem. Maybe everything's in compliance with GAAP, but for some reason the scope is limited. Here are some examples of when a qualified opinion may be given. Unjustified departure from GAAP, inadequate disclosure, that would be a GAAP problem. For an audit problem, that may be a scope limitation. They don't have access to everything. The company provides some but not enough information, so you can't audit certain areas. That's not necessarily a GAAP problem. That's an audit problem. So here's just some examples of the differences. And if it's qualified, it can be either of the two, a GAAP problem or an audit problem. It's usually a material issue, but not severely material for qualified. So it's bad, but not too bad. Overall, the financials are in compliance with GAAP, except for maybe one or two areas. Now looking at the difference between an adverse and a disclaimer. An adverse will always be something to do with GAAP. It will never have to do with an audit problem. Inadequate disclosures, non-GAAP change severe. Now these are the same list as what was with the qualified opinion, only the materiality level is much higher. Now over on the right, the disclaimer, this will never be due to a GAAP problem. If there's a GAAP issue, it's not a disclaimed opinion. A disclaimer means you can't audit. For some reason, you don't have enough information. So technically, a disclaimer is not an opinion at all. You're disclaiming opinion because you can't give one. You don't have enough information. And here the materiality level will be severe. So think bad, really bad. Fraud. Suspicion or direct knowledge of illegal activities, and the auditor is required to withdraw from the engagement instead of giving an adverse. No opinion will be given. You won't even give a disclaimer. You will just tell your management, I'm sorry, I have to withdraw from the engagement. You want to disassociate yourself from any illegal activities. So unqualified is good. Qualified is bad, but not too bad. Adverse, this is really bad. Disclaimer, that's no opinion at all. And if you uncover what you suspect is fraud, you are required to withdraw from the engagement. And that is a summary of audit